BlackRock's Investment Institute explains why it likes Japan, but is avoiding some income assets in an environment where mega forces are set to move markets.
The higher interest rate environment kind of takes the fun out of everything. So the era of just being long the market and don't touch it is going to be more difficult moving forward. AI is going to do for brain work what automation did for muscle work. We were all used to globalization, I guess, a sense that the world was going ever closer technologically and perhaps even otherwise. And sadly, Madison, that now seems to be very much over.
It's Friday, the 19th of October, and you're watching Markets with Madison. BlackRock has just released its portfolio playbook. It shows it's slightly overweight equities, but not on the US or Europe. It prefers Japan. It's neutral on China, emerging markets, and the Pacific. On fixed income, it's underweight long-dated US government bonds because it prefers shorter ones. Beyond that, it's identified mega forces for investors to think about. It says AI still has a way to run, while geopolitical shifts and economic competition is causing a rewiring of supply chains. Alongside shifting demographics, a fast-evolving financial system, and in true BlackRock fashion, the transition to a low-carbon economy. I spoke about all of these with BlackRock's chief investment strategist in the Asia-Pacific, Ben Powell, when he was in New Zealand last week. Well, Ben, lovely to have you in New Zealand and lovely to meet you. Thank you for doing this.
Great to be here. Thanks for having me.
I want to start with the geopolitical risks first, given the events of the past week. This Israel-Hamas war, how do you think that has actually changed the geopolitical environment globally? And does it alter any of your investment theses at all?
Yeah, so look, we at the BlackRock Investment Institute would suggest it's symptomatic of a broadly more complicated and frankly more difficult world. We were all used to globalization, I guess, a sense that the world was going ever closer technologically and perhaps even otherwise. And sadly, Madison, that now seems to be very much over. So we're seeing a more fragmented world. I think that pertains to supply chains, maybe even capital markets, and sadly to the geopolitical arena as well. So I think we're going to see more of this complexity ahead. And that's something we as investors need to be very mindful of.
Specifically on something like supply chains, that very much affects our corner of the world down under. What should we expect to see flow out of that?
I think we should expect to see inflation, really. So the logic here is supply chains broadly have been set up to be very efficient over the last 30 or 40 years because the whole world was on broadly pretty good terms. Now we're in this more complicated world that I'm talking about, Madison, and we want to do business with our mates. So we want to bring supply chains home or have them partnered with people we feel we can trust and rely on. And that's fine. It might even be a good idea in terms of supply chains being more resilient. But by definition, if you have multiple supply chains, it's going to be more expensive. So the politics is it is what it is, right? We as investors just have to kind of learn to cope and navigate this new political environment. But I think one of the consequences of slightly strangely, from an economist's perspective, choosing to be less efficient for political reasons, reasons of resilience, is likely to be less efficiency, which is to say higher prices.
What does that mean for competition between these big economic superpowers like the US, the Middle East, China, Russia?
Yeah, so a lot here. So I think the first thing to say is the big picture, the US-China tensions are going to continue. Some days will be better, some days will be worse, but don't miss the point, right? These are two great powers, and they're bumping into each other a little bit, and that's going to continue. I would say that's going to transcend personalities as well, by the way. So if we do have a change in either America or Chinese leadership in the years and decades ahead, we're still going to be left with a situation of two great powers bumping into each other. So I think that is a new economic, political reality. Again, that's going to impact us in markets. One aspect of this that we think is quite interesting is what we call the multi-aligned countries. So you've got certain countries that are, I guess, broadly on Team US, other countries that are broadly on Team China, but then you've got a middle, 180 maybe, who can a little bit pick and choose. And there are certain countries, it seems to us, who actually might be net winners from a more geopolitically difficult world, which seems strange. Overall, the geopolitical story is scary a little bit and probably negative for economic outlook in aggregate. But there will be individual winners who are able to benefit from a slightly more complicated geopolitical environment.
I do want to speak to you about those countries specifically because I imagine Japan is very much on that list. But just on inflation, if we have more inflation, I imagine that you are in the higher for longer rates camp. How much higher, how much longer could we see out of this?
Yeah, a bit more longer than higher. So we're nearly there in terms of the so-called terminal rates, how high they're going to go. So maybe the big guys, the Fed might do one more, they may or may not. It's a close call. So we're nearly there in terms of the hiking cycle. So I think the new kind of story is going to be how long they stay there, as you said, Madison, and it's going to be longer than would be historically normal. So if you go back to the end of the Second World War, post-Second World War, once the Fed has reached where they want to get to, they normally start cutting about 4 months later, on average, sometimes sooner, sometimes later. But we think this is going to be much longer, maybe 12 months or even more, as they're really determined to keep policy tight and really continue to crush inflation, because yes, it's come down, but it's still much too high in their judgment, we think.
What do you think someone like the Fed would need to see to start cutting, to be able to say we've done enough here and longer is now ending?
Yeah, so a couple of things I guess are possible. One is inflation getting much closer to targets. So the Fed, interestingly, has a slightly loose mandate where they need to achieve 2% over some period of time. So it's not totally clear over what period of time that is, but I think getting closer to 2 is definitely necessary. So there are important conversations as to how we should, how do we think about 2? Does it mean, is 2.5 close enough? Is 2.9? But 4 is not close enough. So where they are currently is not close. So it needs to get closer, maybe 2.5-ish, something like that. That's one thing we could see. The other thing we could see is a bit more financial pain. So if you started to see a reprise of what we saw a little bit earlier in the year with the US regional banking travails, a bit more like that. Of course, the Fed ultimately has responsibility for financial stability. So if financial stability were to start to become a risk, the Fed would change their tune. But for the moment, I have to say, Madison, we're not seeing either of those. So we think the Fed's going to keep on keeping on, keeping policy tight, maintaining these high restrictive rates, which is going to suppress economic growth to try to bring inflation down.
Given that, then why does BlackRock not like long-dated government bond yields?
Yeah, so a couple of things here. Firstly, there's a lot of bonds around, so maybe a bit simplistic, but a lot of supply of fixed income, fairly large deficits in the US which need funding. So a lot of treasuries around. And then on the demand side of the equation, it's quite interesting actually. If you think about who buys treasuries, over the last decade or so, it's been the Fed. Right, so the QE extravaganza is now over. The Fed's trying to get out of that business. And I would say in the round, we're moving from price insensitive buyers. So the Fed, obviously, they're buying treasuries not because they think they're cheap or expensive. They're buying them to pump money into the economy. So we're moving from price insensitive buyers to people like you and me, people who really care, what's the income we're generating here. So the trouble with that is you move from price insensitive to price sensitive. We might need to find a better price, a more attractive price for normal investors, if you like, for real investors. And our concern is that could see yields tickle higher to encourage different buyers, price-sensitive buyers, to come into the market.
It's very hard to find opportunities out there. Even the BlackRock Investment Institute's playbook, pretty much everything's weighted neutral and some things are just ever so slightly overweight, underweight. So when you look at that environment, how do you decide where to actually put clients' money, and how much more difficult is that now compared to a few years ago?
Yeah, I think it is. It's a more difficult macro environment. Inflation, policy, geopolitics, as we've talked about, Madison. I think that's just true. And we think, unfortunately, the higher interest rate environment kind of takes the fun out of everything. So the era of just being long the market and don't touch it is going to be more difficult moving forward, because the rising tide is going to be less rising, if that makes sense. So we're going to need to be more specific, more targeted, more granular. Exactly where do we want to have exposure to risk in the portfolio? So a couple of areas we like, Japan, some aspects of emerging market debt, and some of our mega forces we think are trends, I guess, structural trends, which can drive society, humanity, the economy, and particular areas of the market.
On those mega forces, one of those, specifically when it comes to Japan, is shifting demographics. And that is one that is quite pertinent to the Asia-Pacific region that you and I both cover. There's low birth rates in China. a very much ageing population here in New Zealand. What risk do you think that poses to APAC economies? And do you think it kind of makes them eventually uninvestable? Because without further population growth, a more active workforce, there is not going to be any economic growth in those areas.
Yeah, so look, GDP is pretty simple. Economists try and hide this. So GDP is labour force times productivity. That's all it is. So labour force, as you're saying, is demographically baked in, right? The pie is in the oven already. And so we know what workforce are likely to be over the next 10 or 20 years. So in those countries, you mentioned a few of them, where labour force is going to decline, they have to go for productivity. It's just the math, right? So if labour force is down, you've got to go for productivity. So it's going to be those countries that can offset the demographic headwind with technology, with productivity gains, efficiency gains. Those are going to be the relative winners. So that comes down to policy, trying to create the environment for the innovators of the future to create the companies, the products, the goods that are going to drive not just their own companies, but society and even countries forward more broadly.
Any tips for New Zealand? Because we absolutely need them when it comes to productivity.
I think, and everyone does. I mean, it's a conundrum, right? The world has struggled with productivity for a bit now. So I think two things come to mind, not necessarily as pertains to New Zealand, but in general. One, I do think the demographic aspect. So you can solve for it, I guess, with domestic fertility rates or immigration. So I guess, attractive countries, perhaps like this one, can choose the population, right? A lot of people, I would think, would want to move here. So I'm not making a political point. That's just an economist point. That's an option which is open to New Zealand, which I guess is not so open to other countries. The next point is going to be this productivity focus. And I think we all need policymakers to be hyper-focused on this, giving, innovators the freedom, space, regulatory landscape, regulatory certainty, all of the stuff that economists always dream about, but perhaps is complicated in a politically real world. But that's what we need if we're going to at least try to solve for the necessary productivity gains we definitely need.
BlackRock likes Japan. You're ever so slightly overweighted, but Japan has one of the most longest standing population problems. According to stats this year, 29% of its population is now aged over 65. What do you like about it?
So what's quite interesting in Japan, it's a very nice place, by the way. I don't know if you've been there a lot.
I haven't. I'd love to.
It's great fun. So, but in terms of the market story, what's the main point is the move from deflation to inflation. It's a huge change. Maybe it's obvious, but it is fundamental. And what does it mean for Japanese savers in particular? So in round numbers, Japanese savers have around $14 trillion worth of savings, very rich country, obviously, and half of that is in cash, earning zero or maybe even a bit less. So that's quite interesting. In a world of deflation, where everything's getting cheaper every year, zero is actually a pretty good outcome. Right? So you're staying the same, everything's getting cheaper, you're getting richer in terms of the stuff you can buy. That's now over. You're now in a situation where there is inflation. So what I think we're going to see over the years ahead is some portion of that $7 trillion is going to have to flow into real assets so that Japanese themselves can at least attempt to keep up with the problem now of positive inflation. So I think that's going to be a mega force of a secular bid from Japanese savers into their own real assets. And the numbers are just so huge, Madison. You don't need to be too optimistic. If just 5 or 10% of that $7 trillion moves into real assets, for example, equities, that's quite an encouraging backdrop, we think.
Other mega forces, artificial intelligence, everyone knows that is underway and that's a seismic shift. Can you tell me to what degree you expect that to impact companies and also economies, and how are they going to deal with it?
Yeah, I think it's a big deal. I think it's going to change every facet of human existence pretty quick. So how's that going to play out in markets? A couple of stages, I think. Stage one is approximately where we are now, is the direct beneficiaries, the hardware, the guys who make the chips and that kind of stuff, and that's completely appropriate. But I think where we're going to move now is thinking more about which sectors are ripe for disruption, which areas can maybe benefit from using AI, really harness the technology and generate huge productivity gains at their own company level. So I think it's probably the case that there are some sectors which are more capable of using AI. It was put to me that maybe you want to be a nurse rather than a doctor. So maybe doctors can be a little bit challenged, I guess, by some of the AI moving forward. But nursing would be an example of something it's hard to imagine how AI would impact that. So I think particular sectors are going to see efficiency gains. That's maybe good for equity owners. There are some social consequences, which I'll just leave hanging. That's not my job, I guess, to solve for those, but they're out there. And then what I think will happen thereafter is we're going to have companies and killer apps, so-called, that frankly, I'm not clever enough to even imagine what they're going to be, but they're coming. So I think as much as we saw with the internet, right? So internet, every company in the world is now an internet company, I guess.
You place AI on that same pedestal in terms of
Oh, no,
seismic shift.
absolutely. Maybe, yeah, absolutely. Maybe at least. It's a huge change. I think it's going to change everything. And some companies, some sectors will do a better job, some individuals will do a better job of harnessing the power of that. And I think, yeah, for me, it's such a big deal. It will be a meaningful driver of performance, different performance between different companies, different sectors. Yeah, I think it's very important.
Identifying that as an investor isn't necessarily always easy, though. Obviously, as you mentioned, the chip makers, there's companies that actually play in that space. But how do we look for the ones that are embracing AI and it's actually going to lead to efficiency gains? Any tips on what to specifically look for internally?
Yeah, so I think the sector analysis is somewhat more straightforward. So the frame maybe we can have is that AI is going to do for brain work what automation did for muscle work. So just have a think about brain work and which areas can leverage AI in a efficiency enhancing manner. So there's that. And then company by company, I agree, it is going to be hard, right? It's going to be hard. But we need to be listening very carefully to company management and trying to assess which of these companies is doing a better job of bringing AI into more efficiently servicing their customers, more efficiently generating their own IP and so forth. And there will be winners and losers between companies within the same sector. And I think, as I say, for me, it's such a big deal, such a big change. That's really worth thinking about. It's new, and I totally agree, it's a bit difficult, but I think it's going to matter.
Of all of the major 5 megatrends that BlackRock has revealed, shifting demographics, economic competition and geopolitics, low carbon transition, AI, future of finance, which ones are least to most priced in markets currently, do you think?
Tempted to answer, I love all of my children equally, but
that would be a lie, wouldn't it be?
They're probably watching, so I need to be very careful here. So, which is least? I think, I'm sorry about this, but I think they are all not priced in. I mean, that's why we've identified them as mega forces. So I think all of them, of course, you can dismiss them as bigger picture, longer term, but the market is actually quite bad at pricing those longer term, if you like, slow burn, but significant drivers. So for us, it's not really like a trade idea for this week or next week, but these are going to be structural tailwinds that we think it makes sense to have at your back rather than preventing you from moving forward. So I think all of them equally are underpriced, underappreciated, and have got more room to run in the years ahead from here.
So on a time of neutral, there is still value to be made and had?
We think so, and the key point is the value of thinking in a slightly different way, moving away from this aggregate kind of risk-on, risk-off mindset towards a much more targeted approach. And you can cut that cake in a few different ways, by asset class, by geography, and so on. And we hope that the Megaforce is a helpful kind of framing, a helpful lens to think about a different way, to think about specific areas, themes that can be played in different parts of the market. Whereas, as I say, we feel there's a real tailwind that's going to persist for years to come.
Thank you so much for your time. Been lovely to chat.
Thanks for having me.
Well, if they're not priced in, then all that's left to say is go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.